Welcome, everyone. Thank you for joining us today. This is being offered by SageVest Wealth Management, and some of you, likely many of you, know that we serve as a wealth manager where we participate in investment management for clients, but we serve in many more capacities as a wealth manager and looking at the totality of one's finances. And as part of the services that we provide, we wanted to offer this webinar today as hopefully a series of webinars coming up in the future on various topics that we think are, important and of interest to clients. So we hope that you will join us for those. Just as a few administrative items before we get started, I do want to let everyone know that today's webinar is being recorded. We also welcome questions and answers, or offering answers, but welcome questions. Just in case you're not familiar with how to do that, if you hover over the bottom part of your screen with your mouse, you should see a Q&A box that if you click, you can add a question into the chat feature. Some questions we'll be answering throughout the presentation. Others we may hold, particularly if there's a number of questions, until the end of the presentation, but we do welcome your questions. So today's webinar is on the topic of investments and your personal finances in today's inflationary environment. I'm sure everyone is clearly aware that inflation is running very high these days. It's a topic that we're discussing with clients quite a bit. And we understand that it's something that is on people's minds, both in terms of how it affects their day-to-day investments, as well as obviously an impact on investments with the markets being down a fair amount for this year. So let me walk you through who is on today's presentation in terms of talking with you. Obviously myself, Jennifer Myers, I serve as the president and founder of SageVest Wealth Management. Ryan Albritton, who is a financial advisor with our firm, and Eric Stein of East Bay Investment Solutions, who Eric works at, he's a CFA, certified financial analyst, or chartered financial analyst, and he works with our firm as a consultant to really help expand our investment research. So to that extent, he offers in-depth review of different investments and ideas for us to consider. We still retain and implement all final investment decisions and implementing investment recommendations and trades in client accounts, but we've brought Eric on as an additional resource to gain additional depth in the investment side of the equation. So with no further ado, I'm going to hand it over to Eric to, actually, run through just the topics that we're going to be discussing today that with today's inflationary environment, talking about the recent rise that we've had in inflation and some different components of inflation right now. We'll talk about whether or not expectations are correct, but forward expectations of where inflation might be heading, bond investments and how they're feeling the impacts of an inflationary environment, as well as looking at some historical reflections. We've begun getting a lot of questions about how long bear markets or down markets have continued, the relationship between the economy and a potential recession in the market. So we'll be touching upon that. And then finally, different things to consider relative to your personal finances while inflation is distinctly persistent. So now, with further ado, I will transfer it over to Eric Stein.
Thanks, Jennifer. I appreciate the opportunity to talk with you and your clients today. And you talked about inflation. That's certainly something we're going to touch on today. And there are a couple other themes that are going to run throughout the presentation. One of them is just going to be focusing on the long term of investing rather than making sort of short term adjustments or movements based upon what you are guessing or think may happen. Another theme is talking about the market versus the economy. They are different. They react differently to different things at different times, and we'll talk about why and how that impacts your world from a return perspective. And then we're going to talk about, just not getting caught up in headlines, not getting caught up in the emotions of investing, which I think can be really hard. Money is a very emotional topic. So we just really want to keep emotions out of our investing world. And we'll talk about some of the reasons why we do that. And when we talk about emotions, there are times where we can feel really high about what's happening, and we can feel really low about what's happening. So our approach is really to take more of a balanced view of the world. We try to look at things both from a positive view and also just trying to list some things about, that we're concerned with in the current environment. So we think about some of the things that are positive. Overall, the economy is in fairly good shape. And arguably, you could say that's part of why we're seeing some of the inflation that we're seeing. Unemployment was 3.6 through quarter end. It's running at 3.7 through August. So again, historically fairly low compared to where employment can be. And now, if we think about where we are from a fixed income perspective, if we look at the 10-year Treasury, it ended the quarter at 2.98%. Earlier today, it was around 3.3%. So it's continued to increase. So if you're a fixed income investor, if you are looking for yield, you're actually able to receive yield and return from your fixed income investments, which is a positive, something you really haven't been able to get for a number of years. On the flip side, certainly things we're concerned about. If you listen to Fed Chairman Powell, which I'm guessing many people on the call did not listen to his call very closely in late August. But one of the things he talked about was sort of having a laser focus on lowering inflation. In the past, when inflation got out of control, the Fed would raise rates, the economy might suffer, the Fed would go back in and lower rates and create an easier monetary policy. That is not what we're expecting to happen going forward. What we're expecting is the Fed to continue raising rates until they get inflation under control. And they've actually said that even if there is a recession, which the odds are that there may be one, based upon what's happening, that the Fed is going to continue raising rates until inflation is more under control. So again, that's certainly something to think about. And again, the Fed only controls so much. So they don't control COVID, they don't control lockdowns, they don't control supply chain issues, they don't control geopolitics. There's so many things outside of what's happening, outside of the Fed control, that impacts markets, again, that we don't know. We know what we know, but we don't know what we don't know, that can impact markets in various ways, both positive and negative. So again, it's more the negative things where we're concerned about. So we talk about inflation, if we look at this chart, we're going to focus on this orange line. So we have the years going across the bottom from 1980 to the current environment. On the right-hand side, going up the chart, we have essentially levels of consumer price index. If we look at the orange line, that is the headline inflation consumer price index. That's the number you will see most related to headline inflation. And what you can see is that, as of August 25th, inflation was running at 8.52%. If we go back to the last 20 years, you can see going across, we're well below the 5% threshold. Inflation has been, close to zero for parts of it, or 1%. The Fed targets 2%, but you can see again that hasn't been around 2% on average for a while. And if we go back to where we are today at 8.5%, we haven't seen this level going back to the 80s. And if you keep in mind where we were in the 80s, interest rates were in the teens. Inflation was very high. It was a very different environment than where we are today. Outside of, again, having high inflation, there were different drivers that were impacting markets and rates at that point. But, again, you can see this is well higher than what the Fed is looking for as their target of 2%. And if you think about it, the Fed has a dual mandate. Part of their mandate is to have stable prices, which is, low inflation. Their other mandate is to have maximum employment. And we'll talk about where the unemployment rate is today. And we already talked a little bit about it being, again, a little over 3.5%. near historic lows, it's sort of this conundrum that they have of how do you lower inflation and without having employment continue to go down, and how much further can it actually go down? So it's just sort of a challenge that the Fed is in right now of trying to create a soft landing without a recession, try to lower inflation without increasing interest rates too much, too quickly, and causing other challenges. And if we think about where inflation is, there are lots of different components of what makes up CPI or consumer price index in terms of inflation. So what this chart tries to show is, there's two parts of inflation. There are parts of it that are considered to be stickier parts of inflation, or parts that are hard to get rid of, and transitory or temporary parts of inflation, which, again, can ebb and flow more quickly. And what you can see is, obviously, there are a couple trends that you can see. We can see back in March of 2021, we are at 2.6% inflation. Today, we're running much hotter at 8.5%. We've actually seen a little bit of a dip from where we were in June, down, from 9.1. Doesn't make us feel great. 8.5 is still pretty high. Going to the supermarket is still super expensive, more than it was, a year ago. But what you can also see is that, this transitory component, a lot of this is energy, a lot of this is new and used vehicles, it's food. So if you think about food, we have a crisis going on in Ukraine that's impacting agriculture. We have a crisis going on in Ukraine and Russia that's impacting energy. We've got continued chip issues from China that are affecting new and used vehicle prices. These are all things that were considered temporary that are having an impact. If those things change, we could certainly see a drop in inflation. The other part of this is sort of stickier inflation. And what's interesting is if you just sort of look at sticky inflation, if you look at where it was in March of 2021, it was a little bit over 1% of the 2.6% inflation. If you look at where we are today, the sticky inflation is still over 4% of the 8.5% inflation. So even if we remove all of this transitory inflation, we still have 4% of inflation that's still relatively sticky. So again, there are things that are going to have to happen in order for this inflation number to have to come down to a more reasonable level that the Fed is looking for. Again, their average that they strive for is 2%.
I would just interject back on that slide that while some of these items might be more sticky in nature, they also could contract, as the economy may adjust and some of the inflationary pressures may adjust in terms of pent-up demand. But, if we were to see any pullback in the economy, people might not travel as much. Hotel prices might come down. Shelter is a little bit more, it can be a little more sticky because it predominantly, and correct me if I'm wrong, Eric, but predominantly looks at rents, which, are locked in for, often a year's time frame. But if we were to see things, pull back on the housing front, which is extremely hot right now, rents could have an impact to the positive side for those who are renters. So sorry to interject. Thanks.
No, that's great. And you talk about housing. On one hand, you've got a rents increasing, as you stated, Jennifer. You've also got mortgages increasing because the mortgage rates are increasing. So the rates people are paying to buy a home are getting more expensive. So some people are being priced out from renting and from buying. They're trying to do that math of trying to figure out which is going to be better. And it's just a difficult situation, which either route they go. So a question we often get is, is this going to continue, or how long is this going to continue for? And this chart really shows what the 5-year break-even inflation rate is of, what investors are expecting break-even inflation to be in 5 years. And the way to think about break-even inflation, if we look at it where we are today, it's roughly 2.6%. So what this is saying is, if you believe inflation is going to be higher than 2.6%, in 5 years, you'd be better off in a TIPS product, a Treasury inflation protected product. And if you believe that inflation is going to be below 2.6%, you'd be better off in the 5-year Treasury. So it's sort of the market's way of finding out where people are in terms of what they think is going to be best, or where they think inflation is going to be. And right now, expectations are for 2.6%. Now, again, it's always possible that the market has this wrong, that it could be higher or lower. But currently, that's where people are predicting inflation is going to be.
And even longer term, with the 10-year Treasury being at about 3.3%, both the 5-year and 10-year, the expectations are certainly well below, the 8+% that we're at now.
Correct. Yeah, and so we're going to switch gears a little bit. We're going to talk about the fixed income markets. And what's unusual is, what we've seen this year is oftentimes where we see a dip in the equity markets, historically, we've often seen fixed income markets do well. We've actually seen sort of the opposite of that this year. Equity markets are doing poorly and fixed income markets aren't doing very well either. They're both in the red on a year-to-date basis. So there are a couple of things I want to really point out about this chart, and I'll just try and define what this chart is. On the x-axis going across, we have years going back from 1976 through year-to-date 2022. And on the left-hand side, we've got returns, positive and negative. And this is of the Bloomberg US Aggregate Index, which is the most common fixed income index that's out there. So what we see is on a year-to-date basis, or on a yearly basis, I should say, you can see these bars are, for the most part, positive. So we talk about it on an annual return basis. Of the 46 years we show, 42 years we have positive returns. It's a pretty good ratio where, again, on an annual basis, 42 out of 46, you've got positive years. It's a pretty good ratio. Interesting, last year was one of the 4 years that was negative. So again, being a fixed income investor, odds are you'll have a positive experience in the ag over time. The other component I want to show are these little red dots. As you can see, they happen most year. What these are the intra-year declines. So even in a year where we have a 33% increase in the ag, we actually have a 2% decline that happened at some point during the year. We have, go forward a little bit to the 2000s, we've got a 4% annual return, but at some point during the year, we were negative 5%. So as you can see, it's pretty common for almost every single year to have at least some point during the year where the returns have been negative, even though we wind up in the positive for the entire calendar year. So again, going back to one of the themes I talked about long-term investing, this is exactly why we want to be a long-term investor. Because even though intra-year we might have a negative experience for part of the year, at the end of the year, we're positive. The last thing I want to really show about this slide is, again, just how unusual this year is. We have a minus 13 drawdown on a year-to-date basis. You can see it's the largest drawdown we have. This index actually started in 1976. So of all the years this index has been in inception, this year has seen the worst drawdown. And on a year-to-date basis, it's by far the lowest returning index or lowest returning year that we've seen. Again, what happened for the rest of the year remains to be seen, but at where we currently are, you can just see what an anomaly 2022 has been from a fixed income perspective. So why does that matter? Well, what's interesting is everybody asks us how to predict the equity markets, and I can tell you candidly, it is next to impossible to predict the equity markets. There are not many or really any good predictors of the equity markets. Fixed income is a little bit of a different story though, and what actually is a fairly good predictor of fixed income returns going forward is your current yield. So if I just look at this chart again, on the right, on the bottom, I've got my starting yield going across. On my left-hand side, I've got annualized 5-year returns. And again, this is using that same Bloomberg Ag Index. So let's just go back to the 80s, for example. We'll look at these navy blue dots. And you can see, let's just say, pick a year. I started around 11% in a starting yield. My return was roughly 11%. It's a pretty phenomenal return for fixed income. If I look in the 90s, I have sort of falling yields from the 80s to the 90s. I can see if I started at a yield of 7%, I have a 5-year return of about 7%. Again, pretty sizable return for fixed income. I continue to have declining yields through the 2000s, but still I have a 5% yield starting. I have about a 5% 5-year return. Again, a fairly substantial fixed income return. If we move to the 2010s, you can see where things changed a little bit. We started with very low yields. We had very low income or very low returns. And now what's happening is we're actually starting to move up the yield curve a little bit. And that's, again, part of why we have the negative returns is because with the way fixed income works, If your yields go up, your prices go down. So as our yields are increasing right now, our bond prices are in decline. And that's part of the reason why we have those negative returns. On the positive side, if I have, let's say, a current yield of 4%, I should expect my next 5-year return to be 4%. So as I move up the yield curve, again, for fixed income investors, over time, this will actually be a good thing, as they should receive a higher return for the higher yield where their starting point is. So I just talked about stocks and bonds. I'm going to talk about this very quickly. We look at the percent of months going back to 1976 to 2002 for the S&P 500 on the equity side and that same ag index on the fixed income side. You can see on a monthly basis for all of these years, stocks and bonds have a fairly similar percentage of positive months. About 2/3 of the time, stocks and bonds are both positive. The difference is the annualized return. If I go back to 1976, stocks have an 11.5% return, bonds are less than 7%. This is why stocks return more, why people want to be invested in stocks. It's just had a higher return. You have higher volatility, but you also have a higher return expectation for being in stocks as they are riskier. So I transitioned from talking about market returns to the economy, again, which they are different, and we'll talk about this in the next couple of slides. What this slide is really showing is going back to 1921 through the current day, we're going to talk about expansions and recessions. Essentially, the main takeaway from this slide is that if I look at the average length of my expansions, 47 months, the average length of my recession is 14 months. You can just see that very visually here by the gray charts versus the gray bars versus the blue bars. The gray bars are much higher, and then the blue bars over time. The largest blue bar goes back to the Great Depression. Obviously, we haven't seen anything like that since, thank goodness. But again, you can just see that expansions are running much, much longer than recessions. While they're uncomfortable recessions, again, their length is just much shorter than the average expansion. But the market is not the economy and vice versa. So let's look at it from a market return perspective. Similar story, actually, it's just different timing. If I look at bull markets and I look at bear markets, again, this is going to show you all the bull and bear markets over time. But the main takeaway here is if my duration of my bull markets is 51 months, my duration of my bear markets is 20 months. Obviously, that's a lot longer. And if I look at my return, my average return of my bull markets is 162% positive. My average bear market is down 41%. So again, we don't want to try and time markets, because if I think about trying to time markets, let's go back to February of 2020 as we were entering the beginning of the COVID bubble. We had a 1-month bear market where we were down 34%. And that was very uncomfortable. I remember getting a lot of phone calls from concerned investors of what was going to happen to the economy and to markets and where this was going to go. But again, this was a 1-month duration. The following 21 months saw a positive 114% return. So if you sold out, went to cash, you likely missed most of this experience because you were trying to time the markets and were unsuccessful at it. Again, we don't know anybody that is successful at timing the markets regularly. So our view is to stay invested for a long period of time.
And just to clarify on that, Eric, you're looking at a bear market of at least 20% decline, correct?
Correct. Yep. That's how we're defining bear market in this. So again, we talked about the markets not being the economy and vice versa. And this is a great way to kind of show it and why the markets are actually forward-looking, not backward-looking. So if we look at this slide, essentially what it's telling us is this blue shaded area is the period of a recession. But recessions are always announced with a backward-looking view. It's not announced when we're in a recession necessarily, or when we start a recession, it's always announced after. If we go back to the financial crisis of 2008, we can see what happened. So, back in late 2007, we started to see a decline in the markets, but it wasn't announced that we were in a recession until 2008, and late in the year. So if you tried to get out of the market here, you participated in this entire decline, which is not great. You missed a small part of it, but if you waited to get back into the markets after this was announced, you also missed a lot of the increase in the markets going back to where you were. So again, don't use market signals of when to get in and out of the markets. First of all, we wouldn't suggest timing anyway, but if you were, using market signals would not be a great way to do it from a recession standpoint. And another great example
And I'll
of that,
just say we sometimes get that question of, and this is a great example. You know, the economy is still, it may be cooling off a smidge right now, but it's still running hot by from a lot of standpoints. However, the markets are down significantly. So there's not a direct correlation between where the markets are and where the economy is. And sometimes we'll get the comment of, well, you know, should we just sit back now and wait for things to get better? And, you know, Eric, if you can go back to that slide, although it's also shown on this slide of, you know, if you wait until you get to that second dot further out, you've missed that upside. So if you wait for the headlines to get better, the markets are typically, not always, but typically forward looking and anticipating that things will get better and will start recovering in advance of when the economy gets more rosy.
Yeah, and this is another great example of missing out on based on market signals. You know, again, we had that recession, which was February of 2020 through April of 2020, but it wasn't announced that we were actually in a recession until June of 2020. You can see what happened to the market afterwards. And it wasn't announced that we were out of the recession until actually July of 2021. So again, if you're using those signals, if you're waiting for the headlines to tell you what to do from a market timing perspective, we would not suggest it. We don't think you're going to have a very good experience. This slide is very similar to the fixed income slide that we talked about before. And again, it's just going to show a lot of the same things of why we suggest staying invested in the long term. You can see again, 32 of 42 years for the S&P positive going back to 1980. The challenge is that every year there's some sort of drawdown that's going to create a negative return. You can see negative 34% here at some point during the year. We ended the year positive 16. You know, it just happens every year. So if you try to time the markets, we just don't think you're going to be successful at it. We don't suggest doing it. And again, over time, you can see that most markets are positive. Another way to look at it, again, is the average return. We talked about it before. The average equity return is 11.5%. This chart shows all of the years of the CRSP 1 to 10 index going back to 1926. So we have almost 100 years of data. And what you can see is that, again, more positive than negative, more blue than red. And if we look at this column, this is the 10 to 20% column. There's actually only been 2 years, 1993 and 2014, where we were anywhere remotely close to the 11.5% average return. Some years it's up 33.5, some years it's down 28.8. So again, we have to expect that markets are going to react differently, but on average, you can see that we're going to have more positive experiences than negative. And again, same concept. If you look at the 15-year period of that same index, we've never had, going back to 1926, a 15-year period with negative returns over that entire time period. So stay invested for the long term. Don't try and time the markets. Don't get invested in fads. Don't let emotions drive your investment decisions. And speaking of fads, we just wanted to touch on cryptocurrency pretty quickly. You know, there's been a lot of talk about crypto and Bitcoin in particular over the last couple of years, especially as its price has skyrocketed over $60,000 per Bitcoin. And, you know, Bitcoin has been said to, and cryptocurrency in general has been said to do everything from be a great inflation hedge to be a possible replacement for the US dollar as a reserve currency, among all these other things that people say cryptocurrency can do. And I'm not here to say cryptocurrency is great. I'm not here to say cryptocurrency is terrible. But again, we want to make sure that you just don't get invested in the emotions of the fad, just because simply, again, you can see cryptocurrency is only worth what somebody else is willing to pay for it. And at some point, somebody was willing to pay close to $60,000 per share. Right now, it's closer to $21,000 per share. It's a pretty big difference. And again, there's a lot of people that made some money on the way up. And unfortunately, a lot of people lost a lot of money on the way down. So we don't see cryptocurrency as an investment. We see it more as a speculative tool. If it's something you're interested in, I'm sure you can talk to Jen and Ryan about it. But just again, wanted to make sure people are aware of how cryptocurrency can change on a very rapid basis.
And I would just add to that, as we think historically, as investors and financial advisors and managers, there have been a number of periods over the years where it's the trend. Back in the late 90s, during the internet boom, it was the fact that PEs didn't matter. It didn't matter if a PE was 200 or off the charts, almost unable to calculate because there weren't earnings. And it turns out that wasn't true, that PEs, price to earnings ratios, do matter. And we know what happened after the technology boom. It was the technology bust and the markets came down significantly. There was also a period of time after the Great Recession where the headlines were the lost decade in the S&P 500 and almost insinuating that you shouldn't invest in the S&P 500. Well, as we look historically over, the last decade, if you weren't invested in the S&P 500, you'd be a very sad investor. Right now, some of the headlines going around are that the 60-40 portfolio of having 60% in stocks, 40% in bonds, which isn't necessarily appropriate for everyone, but it's a fairly common portfolio in the industry, isn't the place to be anymore. And I can't tell you precisely what the future is going to hold, but to the point of cryptocurrency, some of these fads, we've learned over time that a lot of the topics du jour do not be the persistent topics that work well for clients.
Thank you, Jen. I'll let you take over from here on the personal finance side.
Thank you, Eric, and thanks for reviewing a lot of those points that typically come up in conversations and questions with clients. We also wanted to touch upon some of the different aspects of your personal finances to consider during a high inflationary time. And, a lot of people are thinking about, do I need to modify my lifestyle relative to what is going on? I'll be honest, for many of our clients, given their assets or income, a lot of times if they're sufficient to cover things and you're not impacting your long-term financial well-being, you probably don't need to make modifications, in terms of you're going to the grocery store or, eating out or different decisions. That said, if you, are able to, and if adjustments are required, for example, if from a paycheck standpoint, things are getting tight and you don't have the resources otherwise, you might look at making some reductions. And, some top items are, eating out, which is more expensive than eating at home, vacations, elective things you might be doing at your house. And if you're able to work remotely, gas prices are high, so that might help. With that in mind, it's also important perhaps to consider, do you want to be a contributing factor to what is going on, or a part of a solution now and in the future? And with that, we mean, if you're doing a lot of elective things right now, like you're doing a home renovation, you're doing a lot of travel, which I get, because after COVID, you want to live a little bit. But to the extent that you're ramping it up, you are participating and helping to bolster the inflation factor, because so many people are doing that at once that it's raising inflation levels. Conversely, you could be part of the solution by maybe holding back on things now. And if we do enter a recession, a great way to get us out of a recession is people spending money. So if you have the means to do so, doing that kitchen renovation then, or buying a car then, would be perhaps cheaper for you and help to be part of the solution of getting us out of a recession. You can, thank you, Eric. From an investment standpoint, as Eric was touching upon, we do feel like it's very important to remain focused on the long term. Again, it's incredibly hard to time the markets. Most people who try to do so, frankly, get it wrong. So we feel, and we always talk with clients about this, of making sure that you have a portfolio structure that gets you the enjoyment of up years in the market and also gives you some protection, so that you're not trying to change course midway. Furthermore, if you are, working, still adding to your portfolio, and you've been contributing, keep contributing, because sometimes people get worried and say, I don't know, I'm going to stay out of the market. I don't want to put any more money in the market right now. The converse is true, that it's much better to buy at low prices than at high prices. And one thing we can tell you with a guarantee right now, we oftentimes can't offer guarantees, but we can guarantee that you're not buying at the high right now. I can't say that it's not going to go lower, but I know you're not buying at the high. We do think it's important that if you are working and, if we could be looking at a potential recession, hopefully jobs are not at risk, but if you do have concerns about a job being at risk, either for you or a family member, et cetera, that it is important to make sure that you have adequate emergency reserves. It's generally recommended of a minimum of 6 months, and really having that in secure cash or money markets or CDs that you can access and not have, much of a market impact. We also have been talking with clients, and this has been coming up as a question, and we have posted a blog article, which I'll just say is another good reason to monitor our blogs and look at our quarterly roundups of blog articles, that there are what are called Series I savings bonds that are currently offering a very lofty interest rate return of 9.62%, which is spectacular in this environment. There are some caveats, just so that everyone is aware, because, if you could jump on this, you would, and maybe you should. The investment threshold is limited to $10,000 per person. So it could be a great opportunity for $10,000, but you can't put $1 million there to capture 9.62%. Additionally, to buy a Series I savings bond, you must open an account direct with Treasury Direct. So you have to go online, create an account with Treasury Direct, and transact that purchase there. Just to let clients know, we cannot do that on your behalf. So this is something you have to do independently yourselves. And then furthermore, it's liquid at any time, but if you cash in the Series I bond, which, by the way, the interest rate resets, so it's not locked in at 9.62%, but if you cash it in within 5 years, you forego 3 months of interest. Okay, so it may be something for people to consider, but for most people, it's not the end-all be-all solution with the limit of $10,000 for investment. Okay. So with that, that's sort of the points that we wanted to review and looking at.
I could just add one thing here, Jennifer, as well. I know that we focused on inflation and investments today, which very important piece of the puzzle. But, as a comprehensive wealth manager, we're looking at the totality of your unique situation. So we're looking at everybody separately and really digging into what's best in their situation. So again, very important that we take these things into consideration, but also remember that it is a bigger picture and we want to make sure to look at the whole.
Exactly. So, one of our objectives with that, as Ryan was mentioning, is to really help you make wise decisions and decisions that support one another, obviously as part of your investment portfolio, but going many steps further in terms of retirement planning, tax planning, asset protection, anything that has a financial element to it. And our objectives are to make sure that you're making wise decisions. And, we believe that hiring a wealth manager helps you to make a wise investment in your future. So, I'm going to say that we have not, let me just check again, received any questions. I suspect that there are questions.
We actually did just receive one.
Just did, because I said I would venture to say there's some out there, so I dare people to put one forth. But before that, I just want to, if anyone's signing off prematurely, just want to welcome you to contact us if you have any questions with regard to the presentation or about your finances in particular, and our contact information is there. All right, go ahead, Ryan.
So I have a question here. I think in part you and I can answer this, Jennifer, but for recent retirees like me, should the projections be recalculated in the short term? And the simple answer there is we certainly want to make sure that we are putting elements into your planning to measure how your projections look in case of a higher inflation environment, in case of retiring. So that's certainly why we want to update them annually. And if there is a particular situation that a client wants to look at and they want to look at updating projections for something that is a little more short term, that's certainly something we can do and be happy to talk to you on a personal level.
And I'll just add to that, for projections that we're looking at right now, obviously the market downturn that has ensued is part of them. So investment price values are depressed in terms of the planning. So it already captures that. Our planning includes a Monte Carlo analysis that looks at different market environments. And we are also, for clients, I truly believe, again, I can't offer any guarantees, and I'm not a betting person, but if I had one thing to bet on is I do not think inflation is going to persist in the 8% level on a long-term basis, because it just, it can't. But we are looking at the impacts of a potential higher inflationary standpoint. We typically look at 3%, but we've also been looking at what if there is a higher interim inflationary environment, and or what if inflation is just a touch higher at 4% on more of an extended basis. There is another question of, will slides be available? We're not going to send out the deck of slides. However, we will have a recording of this webinar available, and we hope to have it either later today or tomorrow on our website. You're welcome to view it there. Any other questions? Okay, well, again, if you have questions and follow-up, you're welcome to reach out to us directly, either by email at info@sagevestwealth.com or at our phone number shown. We're happy to discuss with you. And we thank you for participating today. And as I mentioned, we hope to have this as a series of webinars going forward, and hope that you'll be able to join us on varying topics, hopefully of interest to you. All right. Thank you, everyone.
Thanks, Eric.
Thank you, Eric. We very much appreciate you helping with this. All right.